Carley Ellis, you're an insurance advisor. You work for me at Ungaro Co as our insurance specialist here. Why don't you tell us a little bit about yourself?
So I've been in insurance now for about 10 years. Found myself really drawn to it. It's very protective. I have my own sort of young family. My husband Scott and I have two little boys. So I'm really passionate about insurance.
A lot of people kind of get insurance in a sense, right? Because it pays you out a bunch of money if you drop dead. So to start off with, do you want to describe the probably proper definition of what that means?
That's essentially it. Life insurance will pay you out a lump sum of money if you were to die, right? And we see most people getting this type of insurance because they've taken on a big debt, mortgages, or they've got young children and they're wanting to financially support them if anything was to happen to them.
And that's where I guess I've seen traditionally a lot of people in their building up phase of life, they're really comfortable with getting life insurance contracts because they know if they are the main income earner or not, they want to make sure there's a little bit of money that comes in if there's a corresponding negative event. They want to make sure that there's at least a positive financial event to partially offset it. But when it comes to investors, sometimes there's this thinking that, well, I don't have any debt, therefore I don't need life insurance. What's the best way for everyday investors to think about life insurance?
So your listeners will be really comfortable with these concepts. One is liquidity. So if you're relying on funding to cover you through a horrible event, like a death, you're going to need to hold that money liquid. Okay? If you've got this money invested elsewhere, you're now at the whim of volatility. So you need to be able to predict when you're going to die so that you can do it on a market high. What we don't want to see is that you're trying to pull money out when you're having to essentially fire sell your investments just to fund a mortgage repayment.
To get the liquidity that you need out of your portfolio and to manage that volatility risk, what you would get a life insurance contract? Is that kind of the idea?
That's right, yeah. So you set up a life insurance contract and you've created liquidity with no volatility as a hedge outside your investment portfolio.
All right, now I can hear some objections already. One of them is I already have some cash. I've got $500,000 in the bank in cash. Well, why don't I just rely on that as my insurance vehicle? Why do I need to waste money on insurance premiums? What would you say to that?
Well, I touch on that word waste. If you have $500,000 sitting in the bank, then there's actually an opportunity cost here. Because what are you getting from your savings account at the minute? 2% maybe. If you were to take that money and potentially invest it elsewhere and you're getting a 10% return, we're now looking at an 8% opportunity cost that you could have been sort of getting better return on elsewhere. To put that into true dollar form, if you had $500,000 like you were talking about sitting there, we're looking at a $40,000 loss essentially when you could have been investing that elsewhere. Comparing that to insurance premiums for somebody like yourself, Darcy, mid-40s, you'd be paying maybe about $800 a year for that same $500,000.
Right. So that's interesting, right? Because you'd look at that and you'd say, well, I'd rather save the money that I would otherwise spend on insurance premiums and invest that because I'll do so much better. But in reality, it's not really, we're not talking about the same magnitude of dollars here. $800 does not equal $40,000 in terms of, hey, which one is actually really the cheapest, right?
Yeah, that's right. And something interesting, over a 10-year period, if you were the same 45-year-old male with your $500,000 of life insurance, the cumulative premiums are around about $14,000. So even if you did save all your premiums, it's nowhere near the $500,000 that you could receive if you were to die in that 10-year period.
And I guess then there's also that practical sort of question that you have to ask, would you actually save those premiums? Would you really do that? Because I've met quite a few clients that say they do that, but they never actually do that in the end. So,
and then you're in the same situation that we've just been discussing. You've got an issue with liquidity and volatility again, even if you were to save.
And it's not like we're talking about the product here. We're talking about the solution, right? Like the solution is to get people back on track and create a hedge so that whatever the loss was over here, you can kind of fill in the gap. But it's more than that, right? Because ultimately we need to do that because we're trying to protect people. We're trying to protect the trajectory that people are on towards building wealth and being financially independent in the future. So just bringing this home from your perspective, whether you've seen a claim go through or whether you've experienced it yourself, can you just share a personal experience with respect to life insurance?
Absolutely. So my grandfather was a real salt-of-the-earth farmer, built his portfolio, invested really wisely, and his intent was to leave that money there for retirement for himself and my grandmother. Now, he passed away quite early with cancer, And because he had some life insurance, we were able to use that to pay for funerals, obviously. Then also to get my nana set up in a way in her own home and everything like that, so that when she actually needed that money right at the end of retirement, her investments were still completely protected.
That's cool. And ultimately, she became financially okay,
Absolutely.
even though that event happened.
Yeah.
Which is really similar to a story that I'll share with you as well,
Yeah.
with my my stepdad and my mom. My stepdad passed away, but on the way to passing away, the medical costs really piled up. They had medical insurance, which was the prudent thing to do, but unfortunately, it didn't cover the medication that he really needed to prolong his life. So what would anybody do, right? They
Sell everything.
Exactly. Now my mom, still alive, unfortunately, is not in the financial position that she would otherwise be in. So this is what it really means, right? It's not about buying a product or even investing. It's actually about solving something bigger, right?
Absolutely. Yeah. So that's why we find it's actually quite hard to find a rational excuse for somebody not to have at least some form of life insurance.
That's fantastic. Awesome. Well, thank you very much for your time today, Carly. Really appreciate it.
Thanks for having me.